what that means for you. And yeah, let's make it not complicated. I think our industry, the financial advisor profession, they do a great job of making these financial topics sound confusing, so it makes you think that you need someone to be a secret decoder pin. Not the case. We're here to give you education. We're here to simplify these matters and ultimately distill it down to what is important to you. Should you be making adjustments? Should you not be making adjustments? That's what we're here for. And by the way, we are live, which means you can interact with us. If you have questions, if you want to talk about how do you view estate planning? How do you view taxes? Tax filing season is upon us. The most wonderful time of the year, as some people like to say. How should you be looking at your 1099s, whether it's a DIV or a 1099-R? I've been seeing
OID,
You nailed it. I've been seeing some mistakes that have been made by tax preparers and from clients.
And some of those forms aren't always correct. If you have restricted stock or stock options, you really need to make sure you file correctly because the information on the form may not be the accurate cost basis, gain, etc. And that's just a thing that happens on those a lot.
Indeed it does. But that's what we're here for, meaning you have questions, call the program, put it in front of us, and we'll do our best to get you an answer. Of course, I'm Jeremiah Bates. I'm joined with Alex Lundgren. We are fiduciary financial advisors here at your service. Give us a call, 979-59-MONEY. That is 979-596-6639. Visit therealmoneypros.com. You can also send us an email if you do not want to jump on air. Jeremiah, all four syllables, yes, Jeremiah at therealmoneypros.com. Alex at therealmoneypros.com. It's how you can get in touch with us. Busy week on Wall Street. We saw some turbulence. Obviously, last weekend, we were talking about this on the show where the news broke that there was an invasion into Iran. We see the market react. Clearly, we're seeing a shock in the energy markets. We had oil jump 35% this week. That's the biggest gain that we've seen in futures trading history. Now, of course, the conversation then goes to how is this going to affect the greater landscape? And there's a lot of what ifs that are involved in these types of conversations. I mean, you can look back historically at these geopolitical conflicts, and each one has different characteristics at the end of the day.
Absolutely.
But ultimately, there is an initial reaction, and then there's more clarification, there's more news, there's more updates that happen over a period of time. And generally, it's kind of pushed to the side, and then the markets and investors kind of look at the next thing moving forward. But we're not there yet.
Not yet.
Well, and it's interesting to see the market reaction too, where I believe it was on Tuesday or Wednesday, where there was a report, I believe, from the New York Times that stated that Iran had reached out through certain channels to the administration saying that they were hoping to put an end to this. And then the next day, news, and then positive reaction from the market. We saw a drop in oil prices because the general consensus is, hey, this is going to be short-lived. We're going to find a quick resolution. And then the next day, essentially, a report comes out. It's like, no, that was not in fact the case.
Never mind.
That they're gonna fight tooth and nail to the very end. And now they've really changed their tactic to actually, at least from Iran's standpoint, going after actual oil production and infrastructure on that end. And I think that makes sense to an extent where, Iran, I think they see the writing on the wall. They can't compete with the U.S. and Israel when it comes to the military capabilities. So they're going to do their darndest to make sure that there's a tremendous oil shock, because that's really of what they can do to hinder the objective really of their opponents, at least in this case. So I digress. We look at what that reaction is in the oil market, and there's just clearly a lot of uncertainty. When you look at the price, I mean, we're over $90 a barrel. I think it was up over $94 a barrel at one point, and how that is trickling into gasoline prices. And now we look at how that can translate into the inflation numbers for the consumer price index, because what has been one of the positive trends that we've seen in these inflation numbers really over the past few months, if not year, is, you could argue it's been sticky from a zoomed out high level number, but there's been categories, particularly cost of energy, cost of gas, those have been trickling down. Now, if we're looking at a long duration of a conflict with the U.S. and Iran is still disrupting the energy markets, some analysts are calling for oil to go over $100 a barrel.
Yeah, and we've seen it before and what that does to things, and it isn't a good feeling at the gas pump for sure. plastics, everything that's oil related goes up a little bit.
Well,
But,
we can also see that in certain sectors that took a little bit of a hit this week. And to be clear, I mean, we're still not too far off all-time highs. I mean, maybe a couple percent. So I think perspective is important. But again, these are the headlines that everyone's paying attention to. And if there's one thing I really like to focus on or really hang my hat on as an advisor, working with a lot of clients who are retired, who are approaching retirement, I mean, at the end of the day, no one cares more about your money than you. I think
Absolutely.
the one benefit that we have is that your money or the client's money that we manage or the advice we're giving clients, our emotions aren't necessarily tied to it.
No, but when I look at my account, they sure are.
Oh, 100%. Yeah. Well, because if you think about it, your money, if we were robots and we could just look at money as ones and zeros and mathematical formulas, it'd be really easy to make strategic decisions. But money is generally tied to some type of emotion,
For
right?
sure.
I mean, there's so many books and commentary out there right now around the psychology around money, which arguably is just as important as the calculator
Absolutely.
answer. But again, your money is usually in the form of it's this vacation or it's this quality of retirement or this quality of lifestyle or this peace of mind and safety and comfort. So when you see these headlines and you see these ups and downs in the market and you see that price going up at the gas pump, yeah, it's likely going to invoke some emotions and they're not going to feel great. But where I think that a good investment advisor really gets their value is making sure that the strategy can, number one, absorb these type of market impacts, meaning like the planning was already done. Like a geopolitical conflict is on the table essentially every day. When it comes to being an investor.
And that if you are retired, the income plan that is in place isn't dependent on what the market's going to do. You don't worry that the market has to go up over the next 6 months in order for you to be able to have your spending during retirement. It should be structured differently than that. If you are ready to retire in June this year, it shouldn't matter where the market is in June, if it's at all-time highs or if it drops 15%. The plan should be in place to support that. I mean, because I've been in this business a while, I go back to all the people in late 2007, 2008 who said they had to delay retiring for anywhere from 2 to 5 to 8 years because their account value went down so much. Well, to me, it wasn't structured for them to retire right then at that point and was too aggressive at that point for that. So that's part of it. They shouldn't have been in that position. And that's... If you're just that close to retirement, you got to look at it that way.
Well, whether you are close to retirement, you are in retirement, there needs to be a plan in place. There needs to be a strategy in place where, again, you could either look at these turbulence in the markets as an opportunity, or again, it's not keeping you up at night. Right.
Yeah. And if you have a long time, down markets are fantastic, especially if you're with an employer plan, because you're automatically buying into them. So if you've got 10 years or more left till retirement, I wouldn't even blink as far as the stock market's concerned. Now, prices at the gas pump and at the grocery store, that's a different thing.
Well, 100%. There's a reality to that where, I mean, listen, you're hearing this message and fiduciary financial advisors give hot take of saying, hey, these things, you got to give it time. There's turbulence in the market. And
it doesn't matter. Let it go.
You can't let these short-term market swings really determine your market behavior. It's like, okay, I've heard this a million times. Like, really, what is happening in front of us right now? No, I totally understand that. So let's get into that. Meaning, if you're looking at price movements in the market that we've seen so far this week, we saw airlines get kicked in the shorts a little bit because, if they're going to be experiencing higher fuel costs, that would likely hurt their bottom line. Maybe people don't have as much discretionary spending because, again, our economic output, over 3/4 of our country's GDP is from consumerism, meaning just people buying stuff. So now if you have more of that discretionary dollars that are going to be earmarked to gas at the pump, then that means less money's flowing around and that there's going to be a little bit of a recalibration, which I don't think would be a surprise to anyone. But again, that's what we're here for. I mean, if you're concerned about the rising gas prices, if that's going to affect where you're routing money, that's where we're to help. We can give you advice on basically how to arrive at that decision-making protocol. Give us a call, 979-59-MONEY. This is The Real Money Pros. We'll be right back.
Make this year that you work smarter, not harder with Ataraxis. As your strategic partner, Ataraxis becomes an extension of your business, taking the burden of HR, payroll, benefits, workers' compensation, compliance, and staffing off your plate. You'll have more time to focus on operating and growing your business. Let Ataraxis handle the details so you can focus on what matters most. Learn more at ataraxis.com. That's ATARAXIS.com.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
This open enrollment, start making meaningful progress towards your long-term financial goals. Did you know that a health savings account, or HSA, is the most tax-advantaged account in the U.S.? Contributions are tax deductible, which reduces your total taxable income. Withdrawals for eligible health expenses are also tax-free. And last, capital gains on investments are also tax-free. Did we also mention that it's free for individuals? Visit livelyme.com/pro today. That's livelyme.com/pro.
Now, back to the Real Money Pros.
And we are back. This is the Real Money Pros. I'm Jeremiah Bates, joined with Alexandra Lundgren, fiduciary advisors here for you. Phone lines are open. We are live, 979-59-MONEY. That is 979-596-6639. I got to make sure I go slow with that number. I've been told I'm a bit of a fast talker, and I really skirt over those numbers, so I want to make sure I slow it down and make it clear of what that phone number is. Call us if you have questions. You want to change the topic. You want to talk about estate planning. You want to talk about, hey, I'm projected to get a big tax refund. What would be the best place to put it? Let's chat. Send it our way. Obviously, we're talking about the Iran conflict and really the big market moves that we saw this past week. And clearly what's sticking out for, I think, most people when you look at the headlines and you look at the kind of the ancillary effect of this is what we're seeing in the oil market, right? We saw a 35% surge. We have price of oil up over $92 a barrel right now. We got to also understand that these waves are going to affect a lot of things. Like, this is a tide that's going to raise all boats. Again, I'm going to asterisk this with, it really comes down to how long this conflict could be potentially drawn out. Because there's a lot of forecasting and potential projections out there that are painting out a pretty, I wouldn't go as far as say grim, but you know, one of those is coming out and saying, hey, like oil has a good chance to hit over $100 a barrel if this conflict continues out. Maybe some analysts are calling for $150 a barrel, asterisk, if this conflict is drawn out.
Well, and why do we care how much it is a barrel? Well, there's a direct correlation between what that costs and what we see at the gas pump. For every $10 it goes up per barrel, it's approximately another 25 cents a gallon at the gas pump.
Well, we don't have to rewind the clock too far when we saw that reaction in energy markets when Russia invaded Ukraine.
Oh, yeah.
The oil went up to, gas was over $5 a gallon at that point.
Yeah.
We had inflation running in June of that year of over 9%. But then again, you look at that point in time, I was like, okay, we're seeing some turbulence in the market. But you fast forward, things, they get more information, you get a new forecast, you get a new projection, and things change. There's reactions, there's different movements that are made when it comes to the shipment of this and all of it, right? So again, at this point in time, I would just caution everyone who, if you're feeling nervous based on the what ifs that could happen, just bring it back to the strategy. But let's imagine that scenario. Again, if this is drawn out, we continue to see price of oil go up. Yes, we would continue to see that price of gasoline go up. We'd likely see the cost of, because if you think about the cost of energy when it comes to shipping food, again, go back to that statement, tide that raises all boats. So if this continues, then that effect is going to lead then into what is this overall inflation number. Now, Alex, you and I were talking during the break. It's one of those things when you look at the consumer price index, they have the headline number, and then they have what's called the core CPI. And the core CPI, it removes energy cost and food costs.
Yeah, and that's what they use to determine Social Security cost of living increases and inflation. Right,
which you could argue it on both sides. Where you could be the advocate for that, saying, well, historically, there's so many things that factor into the cost of energy that's more of a bit of a whipsaw that maybe it is important to have these two separations of this calculation, right? Same thing with food. If there's a drought or if there's some weather issues, then that could affect things, right?
But then I could also argue those are the two things everybody has to pay for and is not going to go away.
Like in the financial planning world, a lot of times you break it up between needs, wants, and wishes. Food and energy are in the needs category. Those are non-negotiable expenses that everyone is going to have.
For sure.
Unless you're a kid, right? So now let's factor in, if we continue to see the price of oil going up, then we're likely going to see these categories that people have to spend money on go up as well. And if we're seeing that go up, especially at a headline number, then that's going to translate into a higher inflation reading that we'd likely see on a month-over-month basis, aka the CPI, or maybe the PCE or the wholesale inflation number reports, right? You get the picture. Now, if we're seeing that, then we're likely going to see, which we've seen this week in the fixed income space, particularly the 10-year Treasury yield going up. So if you're seeing these whoever's a market pundit, or you see some headlines saying, the 10-year Treasury yield up, you got to remember that's this inverse relationship. And we've talked about this on the program before, is it's like a teeter-totter, where you have the price of that, let's say, Treasury, that U.S. bond on the left, and then you have the yield on the right. If yield is up, it means price is down. If yield is down, it means price is up. It's that inverse relationship. Right. So meaning if we're seeing the 10-year Treasury yield continue to tick up, it's essentially investors saying that, hey, we don't really have a high degree of conviction that inflation is going to go down and that we're going to see our central bank justify cutting rates.
Right.
Because if we see these, and we've already seen this with the most recent Fed meeting where the members have come out and actually said, it almost seems like there's a higher number of members that are advocating for keeping interest rates steady, and some actually even calling for, we might actually have to look at increasing interest rates because maybe inflation is starting to turn to the upside. And that is something that we could see again.
Maybe
could now, and this is kind of the whole point that I want to make. Maybes, if, could, shoulds. Should you make your should you then pivot your strategy based on these what ifs? And I can use myself as an example.
Okay.
I'm decades out from retirement. Decades, probably 3 decades. My retirement accounts, am I changing my investment protocol? No.
Long-term strategy, you don't do short-term moves.
Easiest way to say that. Well said, well articulated, meaning I'm not going to make adjustments for my long-term money based on a short-term move potentially that's happening in the market right now. Am I still deferring money on a consistent basis? Yes. Am I going to stop that? No. But for me, I look at this as this is a benefit to my future self. Anytime you see the market pull back, which again, take with a grain of salt, because again, we're not too far off all-time highs, maybe a couple percent. So,
yeah,
you know,
it hasn't pulled that back a huge amount.
Right. But again, it just goes to show you that these short-term moves in the markets, these are just a part of the protocol of being an investor. But again, if you're looking at these headlines and seeing where things are moving, I mean, that's really what we can anticipate if we continue to see price of oil go up, price of gasoline go up. But you can also look back for maybe some peace of mind or some historical context of these other situations. I mean, it was 2025. What was it, June? It was summer of 2025 when Israel did an offense on Iran, or I could be misspeaking. Maybe it was the opposite. But we did see it was about a 15% jump in oil prices based on that. So again, these things happen. Obviously, the market's taken in stride. I would say that this is developing quickly, and we talked about these what ifs, would, coulds, and shoulds. If we continue to see this conflict being drawn out and we see oil prices and gas prices continue to go up, we could quickly see that on the other side too.
Yeah.
100%. Meaning if we see any positive news that there is a resolution or there could be a ceasefire, we're likely going to see a pretty big drop in oil. Things will moderate, and then the markets, bond market and equity market, would adjust accordingly.
Just remember, it goes up really fast and comes down a little bit more slowly.
Yeah.
At least at the pump.
Yeah, what is it? It takes the escalator up and elevator down, so to speak, or vice versa when we're talking about price of gases or price of gas at the pump. So again, this is a developing situation, right? And the market's going to move based on if we're continuing getting positive news or negative news.
Let's talk about some opportunities it's bringing.
There's certainly opportunities. Want to talk about Social Security, want to talk about taxes being top of mind while you're filing for 2025, things to look out for. You're getting your 1099s, you're getting all your tax documents, some things to pay attention to if you made certain moves during calendar year 2025. You don't want to arrive at a point where you have to amend or unwind because you were trying to get a quick filing. We'll be right back. Apollon Wealth Management has transformed the way our team delivers financial advice. With their support, we're more equipped and more empowered than ever to provide top-tier financial planning, investment management, and personalized financial guidance. Apollon has been a key partner in helping us achieve our clients' unique financial goals. Whether you're an advisor looking to enhance your client experience or an investor ready to take your wealth management to the next level, reach out today to The Real Money Pros by visiting therealmoneypros.com. Let's elevate your financial future today.
I'm Nick Daniels with Tree City Advisors of Apollon. My team and I help our clients implement tax-smart strategies because taxes are one of the largest headwinds your investments face. We use strategies like Roth conversions, 1031 exchanges, and more because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Begin your home ownership journey today. Look no further than Academy Mortgage, your first choice home loan lender. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Their team of seasoned professionals will be with you every step of the way. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
To the Real Money Pros.
We are back. Jeremiah Bates, joined with Alex Lundgren, fiduciary financial advisors here for you. Visit therealmoneypros.com. It's where you can find us. Open 365, 24/7, interactive website. Take our Better Bucket assessment, our Better Bucket strategy. We were talking a lot about Iran. We were talking about the market reaction, what we're seeing in the bond market, the equity market, the energy shock that we're seeing. If you're feeling concerned or you're feeling some nerves or you have some emotions that you feel starting to creep in that might actually start to determine what actions you're taking, highly suggest you go to our website, take that Better Buckets assessment, and it'll really show you what we advocate for, meaning having your dollars being vested for a purpose, and then that purpose being tied to a timeline. And once we have those figured out, we can solve ourselves into making sure you have plenty of liquidity, so no matter what the market's doing, you can still sleep easy at night. You're continuing to have your assets generate passive income, whether it's dividends or interest, or your cash flow needs are met, and you're still participating in the long-term trajectory and the long-term growth that the markets have provided over many, 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 many years.
Right.
That's where the Real Money Pros. You can also get access to our educational content. So again, therealmoneypros.com. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Send us an email, Jeremiah@therealmoneypros.com, Alex@therealmoneypros.com. If you have a question, we will get it answered on air for you. We did have some questions coming through our email over the week, which we will certainly put out over the air because I think we're getting some great questions and obviously some good client interactions. But Alex, that's what we were talking about over the break with it being tax season.
Yeah.
And you're getting all your tax documents, your 1099s, and I don't do it anymore. I do because I've learned, I've seen situations where these documents that are issued, and what I mean by documents that are being issued is if you have an investment account, let's say at a Fidelity, a Charles Schwab, an E-Trade, or whatever the case may be, if it was held in a non-retirement account and that account had some level of activity, maybe you bought and sold some positions. Maybe those positions were earning some level of income, whether it's interest or dividends, or maybe it was even your CD that was generating some interest and you're getting a 1099 from a bank. Look at those. Just
double check them.
Double check them. Now, it's been a rare bird, in my opinion, that the 1099 DIVs are the ones that are showing the gains and losses are incorrect. Ones that I've seen that have certainly been incorrect, and again, it's a rare bird, just to be clear, the 1099Rs, meaning if you had a retirement account, let's imagine that you had a traditional IRA or 401k that you pulled money out of, meaning you did a distribution or maybe you did a Roth conversion, making sure that that amount was accurately accounted for.
If you do the qualified charitable deductions from an IRA, so if you're 70 and a half and you give directly to a charity from your IRA, it is not a taxable event to you. a lot of those get lumped in with the distributions that are taxable on that 1099-R. And so you're going to have to separate those out when you do your taxes because they're coded the same. Watch for that.
Well, and when you talk about coding, that's an important thing to note because if you when you get that 1099-R, there are going to be some distribution codes on there.
Yeah.
And sometimes those things are coded accurately and sometimes it defaults to an unknown. Meaning it is on you or your tax preparer on your tax return to basically state how is this distribution to be classified.
And make sure if you do a Roth conversion or a non-deductible contribution to an IRA, there's a supplemental form that has to go with your taxes for that to count, and it's called an 8606. Make sure it happens. It's really easy, but if it doesn't happen, it doesn't count.
This is something that I've seen last year, meaning when we were talking about reviewing client tax returns in 2024, high-income earners, they are not eligible to do a direct contribution into a Roth IRA. So we're maxing out all these other sources, and now we're trying to find another efficient landing spot for this net cash to be the most efficient from an investment standpoint. So that's where this backdoor Roth conversion comes into play, meaning if you're above those income thresholds, you can put money into a traditional IRA.
Mm-hmm.
You do not deduct it on your tax return.
So you pay tax on it.
Correct. And then you just do a Roth conversion, meaning the money just goes from your traditional IRA to your Roth. Like it's very simple. It's just a loophole that we have where if you make too much money and you still want to put money into the Roth,
that's how you do it.
You just take that route. And what I ran into is that on these returns, that money that came out of the IRA, which should have not been a taxable event, it was marked as a taxable distribution. So meaning in this
they paid tax on it twice.
In this client's case, they were reporting an additional $14,000 of income out of an IRA distribution that should have never been taxed.
I see that a lot. That's why I mentioned the 8606. The other thing that I've seen a couple of times, not a lot, but a few times, is missing the distributions from a Roth and coding it as a taxable distribution on the tax return.
Right, because if you pull money out of Roth, the whole point of doing a Roth is that when you take the money out, the money actually leaves the Roth IRA. You're not paying any income tax on it.
And a lot of times it's coded unknown.
Mm-hmm. So all that being said, if you're hearing this and you're like, well, I did a backdoor Roth conversion in 2025. I just got all those tax documents. I didn't look at them. I just uploaded them to my CPA's or accountant's portal, or I just dropped it off at their office. How do I make sure? Just make a note. Like what I'll do on my tax docs is the CPA that I work with, it's all electronic, which I appreciate. It's just like, hey, upload everything. Mostly everything that I get now is just in electronic form. I could get it off I can get it off the website or whoever holds the account in most cases. And I'll make a little note on that on top of it. I'll just put, hey, this was a non-deductible, or if it was a rollover. Good example here. Had a client that reached out and they did a rollover from their 401k to their IRA.
Right.
And they reached out and they were like, I got this 1099-R that showed that we took a bunch of money out of my 401k. And I'm like, okay. And then I'm like, no, actually you did a rollover. It's not taxable. So this is all going to get trued up on your tax return. So make sure, and I work closely with this CPA. So they're sharp, they're savvy. I'm very confident that they would understand that just in this situation of why would this person take out that level of money out of their 401k.
You can always take in your first month statement and show the deposit that matches it. So they've got the documentation.
Exactly. But meaning you're painting the picture. Like you're making sure that you're stacking the odds in your favor that whoever is doing your taxes is not going to make a mistake.
They don't have to guess.
Exactly.
Just give them as much info as you can.
So meaning in this case, the money went from their 401k to their IRA via a direct rollover, not a taxable event.
So it's basically a transfer.
However, that 401k, where they hold the 401k, they're still going to give you a 1099-R.
Yeah.
So just making sure, hey, this 1099-R, it's not taxable. This was a rollover. If you need any more information, just let me know. I can get you the true up. But so then they know, okay, great. It was a rollover. We know how to process that on the return. So if you're making these moves and you're making these, which I highly advocate for, right? There's tax efficient strategies that you absolutely should execute, but where things can get unwound or things can become a kind of a pain in the neck is if It's the execution.
Yeah.
When it comes to executing the return, the strategy that you execute as far as making the tangible movements, that all has to be properly recorded on your tax return. So you could have made the best moves under the sun, but if it's not properly accounted for on your tax return, you could be running into some issues.
You didn't get the benefit. Yeah.
Exactly.
Yeah.
And then you could be looking at amendments and just
A mess.
and then you're paying extra money to amend it, and it just could be just more time and effort spending on this. Where if you just made a simple note or just put that information out there, then you know. Or if you're self-preparing, understanding, okay, I did this Roth conversion, but I got this 1099-R, I'm punching it into whatever self-preparing software that you're using, and like the numbers aren't checking out right. Well, then you can route yourself and then say, okay, well, I did this, so then what do I need to make sure I input on the tax return so it's all trued up at the end of the day?
Yeah.
So it's important, especially now that taxes are top of mind.
Yes. And have you seen there's some delays in refunds?
Okay, let's talk about that at the state level, right?
At the state level, because there's, with all these tax changes, there's a lot of new software, new processing that some of these states need to process it correctly.
And
also,
I guess the context is the Big Beautiful Bill. So the Big Beautiful Bill, they locked in and made some adjustments and changes at the federal level
that are also affecting states.
But states, there's a handful of states. I mean, most states, they either didn't accept it, like they had the ability to agree to it or not.
Yeah.
But there was a little bit of a delay in a number of states that actually said, yes, we're going to adhere to this or we're not.
And how they process that.
And how they process it, which can trip up a lot of things. Because if you're dealing on some which most CPAs do, they're leaning on tools to make them better at their job. They're not just handwriting all these things out, right? But which means that software that they're using needs to catch up with the new state law. So meaning...
Well, and the state's software needs to catch up when they read them when they come in.
So now it begs the question, do you rush to file your return? Maybe not. Good question for your CPA or your accountant or whoever's doing your taxes, or doing a little extra research if you're self-preparing to maybe get everything in the hopper ready to go to click the button, but maybe just don't actually click it, so it delays maybe your state refund, delays that filing. It's how it goes. You know, we're talking about taxes. Usually these things do not happen quick and efficient when it comes to the filing, right? So just something to look out for. Again, this is The Real Money Pros. We got to take a break. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs, from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Have you ever met with a financial advisor looking for some advice just to leave being sold an annuity you didn't want? At Tree City Advisors of Apollon, we do things a bit differently. We focus on your financial goals, helping you fix past mistakes, simplify your current finances, and plan for the future with confidence. Your first consultation is always free and without obligation. Visit TreeCityAdvisors.com and start your journey to financial freedom now. That's TreeCityAdvisors.com.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then then used tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Back to the Real Money Pros.
We are back. Visit therealmoneypros.com. Our site is interactive. Some great features on there. You can access our historical content. We put plenty of educational videos out there, whether it's myself, Alexandra Lundgren, our advisor Nick Daniels, or Alec, meaning we have a whole team out here where we can take the information and strategies that we are implementing for real-life individuals here in our office, and we want to put that out there and make sure that you know about them so that you don't run into pitfalls, they're not done incorrectly, and if you're hesitant to make the action, well, then that's where you reach out, because you can have – what's the saying? I don't know if there's a saying or a cliche. I mean, there's cliches around everything, but when you're almost just in this cycle of just getting information. So like you're getting all this great information, you understand it, and you're doing all this research, which is fantastic. But if there's never the steps to taken to actually get it done or execute it, then kind of what's the point of having all that great information?
If knowledge produced results, we'd all have perfect marriages, six-pack abs, and be millionaires.
Yep.
It takes action.
There you go. Well said. Perfect way to put it. So again, that's what we're here for. Visit therealmoneypros.com. You can call the program. We are live, 979-59-MONEY. That's 979-596-6639. Send us an email, Jeremiah at therealmoneypros.com, Alex at therealmoneypros.com. Had a question come through email, and I'll summarize it. Basically, it is the listener has a solo 401k, an individual 401k. So what that means is that they are self-employed. They don't have any employees, meaning it is just one person, or if there is another person in the business, it's a spouse.
Right.
Okay. So they're utilizing what's called an individual 401k, aka a solo 401k, which lets you defer the limits. So let's imagine you're an employee and your company offers a 401k. You're probably familiar with how much money you're eligible to defer into there as an employee. Maybe your employer puts some money in there as a match. An individual 401k operates very similar as far as the limits that you can defer money into on a pre-tax basis or on a Roth basis.
Yeah, so it lets a self-employed individual contribute a lot more than by using just an IRA or just a SEP.
And the question more is around now that the individual that's using this individual 401k, they now have over $250,000 in this account. And they're asking about, how do I go about, or I heard that I need to file a 5500.
Yeah, and a 5500 is a tax return for a retirement plan. So if your employer sponsors a 401k or a profit sharing plan, every year they file a tax return for that plan that discloses basically the number of participants, the number
how much money went into it for contributions,
what's the total balances, how much was paid in fees, all those different kinds of things.
It's basically just a summary of the activity that took place inside of the
sure.
401k plan, meaning how many participants started, how many were there at the beginning of the year, at the end of the year.
How many were eligible versus putting money in, blah, blah, blah.
All that good stuff, right? Now, here's the thing that's very important to pay attention to, because I think this trend of self-employed individuals using an individual, aka solo 401k, that trend is increased, which is
Absolutely.
great. Highly advocate for these if it's a right scenario. And a lot of times it could be a better option than using a SEP IRA or a simple IRA or even just your standard traditional IRAs or Roth IRAs. These individual 401ks, the deferral limits are a lot higher. There's a lot of optionality within and how you can design these plans. They're great. I digress. If you're utilizing one of these, you need to pay attention to the balance that you have in that plan by the end of the year. Because let's just imagine you have 2025. Within that year, if that individual 401k had a balance, now has a balance of over $250,000, you now need to file that $5,500
Right.
EZ.
The other thing that I think people either don't realize or forget is because it's a 401k, not a SEP, not a Roth, it isn't just an account. It has a plan document that governs it. And usually it's provided by the place you set it up. If you open it at Schwab or Fidelity, they have a default plan document. You can go out and get a custom one, but then you open the account a little bit differently. But this document governs what you can and cannot do in the plan. If it doesn't allow for Roth, you can't do Roth. If it does allow for it, then you can. It also indicates the name of the company, the tax ID, whether it's you as a solo entrepreneur or if you have an S Corp, then you use your EIN. And all of those things are oftentimes part of that 5500 filing because now you have to put in codes for what the plan does or doesn't do and the tax number of the plan.
Indeed. Big takeaway here is that if you're using an individual 401k, great. Pay attention to that balance.
Yep.
And an easy way how you can quickly get over that $250,000 mark is, let's imagine you had a previous employer's 401k, or you had a traditional IRA that already existed, or maybe a SEP IRA, and you rolled that money just to consolidate all those accounts into
And
that
so you could do a backdoor Roth IRA.
Yep, you're tracking with me. So meaning you rolled all that money into that individual 401k, you can quickly get over that $250,000. So if you're listening to this and you're like, oh, I was over $250,000 like four years ago, and I never filed the 5,500. You're okay. Take the steps to get in line. Make sure you're filing those documents, because the more time that goes past, if you missed it, you could be running into some steep penalties for that.
Right. They're usually pretty forgiving. I say usually if it's within a couple of years and one of those beg for forgiveness I didn't know. And the form's not a terrible form. I mean, I don't want anybody to be afraid of it. It's not difficult, and especially after you've done the first one, it's just kind of changed the numbers.
Yeah, and you can file it online. It's extremely simple. So, Amy, great question. Thank you for sending that via the email. Bottom line is, yes, if your solo 401k is over over 250,000, if that happened in 2025, make sure that you get that 5,500 filed for that 401k plan. I believe the deadline for that's
September 15th.
September 15th, if you file an extension. I think it's like 6 months after then the plan year date ended. But I'll put it this way. Get it done sooner rather than later so you have that peace of mind. But certainly a great question. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639. Okay, we're talking about taxes. What are the things that you can do still now before the end of the year?
Yeah,
not before the end of the year, before tax filing time, April 15th for most individuals.
Yeah, because some things, if they're not done by 12/31, you can't do them. So like a Roth conversion, if you do it now, it's for 2026 tax year. But we can still do contributions to IRAs Roth IRAs.
Which means you could still be eligible. You still have time to do a backdoor Roth conversion for tax year 2025, meaning you're putting money into that IRA for tax year 2025, and then you can convert that to a Roth, and that conversion would count for 2026.
What about HSA contributions?
Okay, let's talk about HSAs, because I've ran into this 3 times over the past 2 weeks with new clients that I've met with, because it's one question that we ask is, hey, talking about your health insurance, let's dive into it.
That's your best tax.
Is it HSA eligible? And either answer was, I don't know, and then they come back and say, oh yeah, I was. I said, did you put any money into it? And the answer is no. Well, it's like, okay, we got to find out, because you still have up until April 15th to do that health savings account contribution, which means the money you put in there is going to reduce your taxable income. and pretty
You
good.
probably never pay tax on it.
And a pretty good chance you're going to have healthcare expenses. Yeah, perfect. Then let's take advantage of hey, listen, I'll be the first one to scrutinize health insurance when it comes to the cost and all that. Don't get me started on that tangent. But if it's HSA eligible, take advantage of that. That's a way you can defer dollars on a pre-tax basis, reduce your income, and set that money aside for those healthcare expenses that you will inevitably have, in my opinion. So it's a great feature to have. And you have up until April 15th to do that contribution. So if you're listening to this, you're like, well, I don't know if I was HSA eligible in 2025. Go find out. Find out.
Yeah.
It's you don't really need to do too much research. Maybe if you're working with a broker who got you set up on your insurance, ask your HR. And then even if you had a health insurance plan through your employer and it was HSA eligible and you did not put any money into it, you can go set up your own HSA and make that contribution for 2025. And this is numbers that
People don't realize that. They're like, well, I didn't defer into it from my paycheck. I guess I missed it. You did not.
Let's imagine you and your spouse are covered by an HSA eligible plan. You're both over 55, age 55. You can put $10,550 into that HSA for 2025, meaning you're reducing your taxable income by that amount, and that money goes into an account for you that you can use on eligible healthcare expenses. And that is a long list.
Yeah,
this
very
is long. We don't need to get too complicated with these tax savings. There is low-hanging fruit that you can take advantage of that makes a big difference over the long run. We'll take a break. We'll be right back.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational material, and more. This program is brought to you by the quality sponsors heard within this broadcast.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. Ataraxis partners with businesses of all sizes and industries. Their mission? To reduce the stress and risk that comes with business owners trying to do it themselves. Visit ataraxispeo.com. Ataraxis, elevating businesses for the benefit of all.
Your emotions can drive many decisions, but when it comes to money, they shouldn't be in the driver's seat. I'm Alex at Tree City Advisors of Apollon. We get to know you and your goals to build a holistic, time-based investment strategy. Investing isn't rocket science, but having the right partner helps you stay the course. Learn more about us at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
Are you a do-it-yourself investor looking for ideas from a pro, but not necessarily interested in hiring a pro? Well, I have something to share with you. I build investment allocations for my clients on a daily basis, but sometimes people simply ask if I will share my ideas with them. My answer? Sure. The way I see it, I'm lucky these people consider me to be an expert. So I started writing a quarterly newsletter with model portfolios built for different purposes. My readers get to decide if they want to follow any or some of my ideas. Now, powered by freedomfolios.com and the use of their TD Ameritrade account, my followers can get their investment portfolio in line with my suggestions with the simple push of a button. Using the freedomfolios.com technology is simple and it's fast. I update my models once a quarter, and freedomfolios.com then sends my subscribers a message via email or text letting them know that they may want to update their investment accounts. It's the least expensive way to get professional models without the cost of a pro. Visit freedomfolios.com. See my models there. You can start your free 30-day trial right now. It's freedomfolios.com.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
To offer valuable advice and earn clients' trust as an advisor, it's essential to always put their interests ahead of personal gain or the preferences of any particular company. Advisor Insurance Solutions is dedicated to delivering insurance solutions from an advisory perspective. They provide objective and unbiased insurance planning, making it an integral part of their comprehensive advisory process. If you're looking for insurance guidance that aligns with your financial goals, visit therealmoneypros.com. That's therealmoneypros.com.
Are you in the market to buy a house or just looking to refinance your current mortgage? For helping individuals and families achieve affordable homeownership, Academy Mortgage is a first choice. And when finding that perfect loan for the perfect home, you need a company that will treat you like family, not just another file. To help you navigate through today's ever-changing housing market, Academy Mortgage has zero down options available to you. That includes zero down with no mortgage insurance. We also offer medical professional loans and 2-1 rate buy-downs that help lower your monthly payment for the first several years of your loan. Origination, processing, underwriting, and closing and funding will all happen in-house. With over 34 years in the business, we know that buying a home is more than just a house. That's why it's important we protect our customers and safeguard their financial wellness for years to come. Visit us online at academymortgage.com today to start your journey to homeownership with Academy Mortgage. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Nobody protects you from mayhem like Allstate. I'm a speed bump. Did you hear what I said? I'm a speed bump. And if you have cut-rate car insurance, the cost to reattach your muffler could really be a bump in the road. So switch to Allstate, save money, and be better protected from mayhem, like me.
Based on coverage and limits selected, subject to terms, conditions, and availability. In most states, prices vary based on how you buy. Allstate Bar and Casualty Insurance Company and affiliates, Northbrook, Illinois.
Running out of gift ideas for your loved one? Send flowers with Flower Fix. And need to create joy in your living or workspace? With many working from home these days, create joy in your space with flowers. Flower Fix is a subscription-based flower delivery service perfect for birthdays, anniversaries, or any special occasion. We offer 2 subscription options to choose from, a text-based subscription or a traditional one. Enjoy these big, beautiful hand-designed bouquets that are delivered straight from our flower fields to your door. Log on now, www.flowerfix.com, to choose your flowers today. Have control over when you want flowers delivered. Weekly, bi-weekly, monthly? Get your flower fix at flowerfix.com. Use code FlowerFixPro to receive 20% off your first order. flowerfix.com.
Hi, I'm Stephanie Gallegos with Price for Life. Do you have a life insurance policy that you'd like to sell? If you don't need the coverage anymore or would rather not keep making the premium payments, visit our website, priceforlife.com. Don't let your policy lapse when you can potentially get a cash payment for it. There are several reasons why a life settlement might be a great value to you. Perhaps your policy is too expensive, or you feel you no longer need the death benefit, or you may think you need to wait until death before your family can get the money from the insurance company. This is why you may want to consider a life settlement. Price for Life has excellent resources available along with a free evaluation process to help you understand the value of your policy and the options available to you. Price for Life's clients have received hundreds of thousands of dollars for their policy when they would have otherwise just let it lapse by stopping the premium payments. Get the compensation you deserve. Visit priceforlife.com today and fill out the case evaluation form to see if your policy qualifies. That's life.com. priceforlife.com.
Healthcare expenses can be a burden, so why not make the most out of the money that we'd spend anyway? Take advantage of the most powerful tax advantage account title available to us, a health savings account, also known as an HSA. That's why you need Lively. Visit Lively right away. Open your HSA, roll other HSA money into that new plan, and then start saving. I know you're going to love the entire experience. Visit livelymee.com/pro today. That's livelymee.com/PRO.
Money Pros is brought to you by The Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
We are back. This is The Real Money Pros. I'm Jeremiah Bates. She is Alexandra Lundgren. We are fiduciary financial advisors here at your service. We are a money show. We're not here to sell you anything. We're not going to sell you insurance. We're not going to sell you some magic product that is going to allow you to protect your money, but also participate in market-like gains and all the complexities that go with that. No, we're here to talk about what's going on. We're here to make things simple. Like, again, I said this before at the first hour, is our industry does a great job making things sound complicated when it comes to investing and everything like that. And the reality is it does not need to be complicated.
No, and sometimes you just need to have spent some time seeing how a rule applies in a multitude of circumstances to see where it's the same, where it's different, and just what the end result looks like.
Indeed. There's a lot of great financial shows that you can listen to on the weekend. So number one, we appreciate you joining us. And what makes us different? We're live. You can call us. You can interact with us. Go to our website, therealmoneypros.com. Send us an email, jeremiah@therealmoneypros.com, alex@therealmoneypros.com. And again, phone lines are open 979-59-MONEY. That is 979-596-6639. We're going to go to the phones right now. We have Ken calling out of our home station, 670 KBOI. Ken, thanks for holding. We appreciate it. What can we do for you?
So I have a question. First of all, thanks for taking my call. My question is, I'm going to be 73 years old by the grace of God next week.
Happy birthday.
I still, thank you. I still work full time because I enjoy it.
Okay.
And I have a 401k program that I contribute to. And I know that at 73, you're supposed to have to start taking RMDs, right?
Correct.
So someone told me that if you are still full-time employed and you owned 5% or less of the company that you work for, you don't have to take the RMD. Is that true?
It kind of is. You're really close. So as long as the 401k is the one sponsored by where you're working, so if you have an old 401k someplace you don't work, you do have to take it from there. But if the only one you have is the one where you're working, and you are less than 5%, so 5% or greater have to take it, so it's just that one little percent, but less than 5%, you are correct. You do not have to take it until the year that you leave employment. So if in 2028 you decide, that's it, I'm done, that year you will have to take it. But typically when you distribute that, they will send you your RMD and only do the rollover transfer to an IRA of the amount that's eligible. Not always, so watch them. But yeah, as long as you're still working, then you don't have to take that RMD. You are correct. Now, if you have outside IRAs, they will be subject to it still.
Ken, Jeremiah here. That was going to be my follow-up question. Do you have any other accounts that you were deferring money to, like into a traditional IRA or previous 401k? But it sounds like that's not the case.
Nope, I do not. I've been working at this company for 40-some years. So
wow.
That's where I have everything invested. So do I need to fill out any forms or anything, or is that just automatically assumed that I don't have to do that?
Likely you will. It depends who is doing the administration on the plan. I've seen both. I've seen ones where if you don't have to take it, they don't even contact you. I've also seen ones where since you can take it, they'll contact you and ask you if you want to. So I've seen both.
Okay. All right.
But
all right.
yeah.
Well, it sounds like what I heard is correct then. Thank you so much.
Yeah, somebody knows the rules.
Thank you, Ken. We certainly
Great
appreciate
question.
the call. Thank you. No, it's a good question. I mean, you hear, and there's been some changes with the rules when it comes down to these, when you have to take your RMD. So just for those of you listening out there, if you were born, so here's the key rules that you need to pay attention to. So if you were born in 1950 or earlier, your RMD is going to be 70 a half or age 72.
Yeah,
if you're born,
already in.
Yep. If you're between 1951 or 1959, that's your date of birth. Your age is 73. If you're born 1960 or later, RMD age is 75.
Yeah. And then there's funky rules about, do you have to take it by the end of that calendar year? Do you have till April 1? Not April 15, April 1 of the following year and take 2. It's just talk to somebody.
Well, yeah.
If you're confused and not already taking them,
but since we're here talking, okay, so you got to take your first RMD by April 1st of the year after you turn, let's just say you're beholden to age 73. So like Ken's call, let's imagine if he was required to take an RMD. Let's just completely pivot from this.
He has an IRA and he has to take
He's got an IRA, he's got to take an RMD. Meaning if he turns 73 this year, you have to take your RMD by April 1st of the year after you turn 73.
So it'd be 2027. But there is also going to be a 2027 RMD. So it would mean you would have 2 taxable RMDs in 2027. But it might be a good thing to do. You could be really strategic in how you do this, potentially for taxes.
Well, yeah. So now that we're on the topic of required minimum distributions, this is something that should be taken in the protocol of your total planning. Because I think what's a big surprise for a lot of my clients when we're reviewing the plan and we're reviewing their distributions year over year, where's money going to come from, how's it going to flow in compared to their expenses and all their other income sources and investments, and their mixture of where their assets are actually located, meaning is it pre-tax money, is it Roth money, is it non-qualified money, maybe just a brokerage account, maybe they have some real estate, some income from rental properties, maybe a commercial building, all of that. You get the picture, right? So how do all these things coordinate together? And then one big surprise is those clients that have really been aggressive with doing contributions into pre-tax accounts.
Yeah, tax-deferred pre-tax.
Think of like a traditional 401k, a traditional IRA, for self-employed, maybe a SEP IRA. At some point, the IRS is going to say, hey, you have to pull money out of this. And if you don't, you're going to be penalized. So we can kind of project or forecast what those RMDs are going to be based on the growth rate, and then what balance that would be, and then what they would have to take out. And if you just want a close count number, if you're like, well, what's my RMD going to be? I'm age 70. Just think 3 to 4% of the account value. So take what your account value is, multiply it by 4% on the high side. It's going to give you a rough range of what you are going to have to take out in that year.
Yeah, as long as it's in those tax-deferred accounts, you're basically in partnership with the IRS on this money.
Well said. Now, here's the kicker, though. Great, you get an idea of what that RMD is going to be. What does it actually mean to you? If it's in a pre-tax account, that money is going to be taxable to you as ordinary income.
Right, not a gain, ordinary income.
Ordinary income. So this also, so you can arrive at a few different routes here. Where and I got a number of clients who are retired, where just meeting their cash flow and their lifestyle and taking distributions, they're satisfying their RMD, meaning just money that they're going to spend anyways, pulling that money out to fund everything. They're already satisfying their RMD. But I also got a lot of clients where they don't need it. Meaning if they take it, majority of that money is just being sent to taxes.
And that's where qualified charitable distributions can come in. If you're charitably minded, you can have that money go directly to a charity, not you first. It has to go from the IRA directly to the charity, and then it's not taxable to you as a distribution, and you don't have to itemize and do charitable deduction stuff on your taxes.
Well, and also, too, this is where you could, we talk a lot about Roth conversions, meaning if you see that big headwind of RMDs that's maybe 5-10 years down the line, now you got to think of ways that you can effectively lower that balance, would then in turn lower that required minimum distribution, or maybe get rid of it entirely.
Right.
And that's where Roth conversions could play in your favor.
A really down market's a great opportunity for those.
Absolutely. Or just distributions, meaning instead of pouring that money into a Roth, meaning if the money was still to be invested, you're not going to use it. Really like those Roth conversions, but if you want to use that money to have it be a tangible purchase that increases your quality of life, then great, do that distribution. But the ultimate.
I had a client this week. We were talking about potentially doing a Roth conversion because her income's pretty low and there's this extra deduction because she's 65 or over. And we can figure out if her income this next year is about the same, she could take out $4,000 from her IRA with basically no tax. Well, that sounds like a thing we do.
Yeah.
I mean, zero tax, let's do it.
Well, and then, I mean, even on the qualified charitable distribution. So I had a client where every year they're gifting to a 501c3. He was just doing out of their checking account, savings account. It was about $6,000 a year. I'm like, geez, let's do that. We know that money's going to a qualified charity. Let's just change the source of the money. Meaning instead of it going from your IRA to your checking account and then to the charity, we're going to send it directly to your IRA, which means that we're reducing your income by $6,000 that would be reported, which gives us more room for those Roth conversions or extra distributions. You can quickly see how the location of your asset and how you strategize that becomes extremely important. And also, like Ken had on that call, understanding the rules and making sure you're not getting tripped up, penalized, or taking RMDs when you don't have to. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
To the Real Money Pros.
We are back. This is the Real Money Pros. Again, call us. Phone lines are open. 979-59-MONEY. That is 979-596-6639. We had a great call from Ken, who had it's a real kind of rules-based question around information that he received. It's like, hey, 73 years old. I am aware that I am of RMD age this year. I'm still working. Love what I do. Don't want to leave. And which means, hey, I've being efficient with my dollars, I'm still going to route them to the company 401k. Do I need to take RMDs out of that 401k? Well, turns out that he does not, because he's not more than 5% owner of that company, which only applies to 401ks, by the way.
And only to the one where you are currently working.
Yes. But it also brings up a good question where, you could argue that Ken is the outlier in this regard, meaning 73, still loving what he does and still happy to show up. I mean, that is great, getting some fulfillment and good quality of life. Like, I could say it's uncommon, at least in my experience.
It's not the majority of people.
Most people arrive at a point where like, okay, I'm done. Like,
how can I get out of here faster?
Or the question you ask, like, hey, when do you want to retire? Yesterday. I'm like, okay, well, let's see what we're working with here. And it's interesting because let's imagine if Ken was on the flip side of this, of like, hey, I do want to shut it down. Like, I do want to retire. And how do all these things incorporate and work together? And generally, you're going to have moving parts. And one of those moving parts that it should be top of mind for when you're approaching retirement or in retirement is Social Security. Mm-hmm. How do you elect that filing, and how do you effectively analyze that to make sure it's to your benefit? And not saying that it's something that's slept on by a lot of individuals, but Alex, I think you and I have both seen this where maybe the individual is not armed with enough information or really understanding how their other resources in retirement, whether it's their investments, maybe it's a pension, maybe it's longevity, or maybe it's the health situation of their spouse and their spouse's Social Security as well.
Absolutely. Yeah. I think it's more flexible than people think it is. I will say that the tools on the websites have improved. They've gotten better. But there is an oftentimes a misunderstanding that when I quit working, I have to start Social Security, and you don't. Retirement and starting Social Security are two different things. So it's good to figure out what makes sense, because I hear a lot of people told by, and I'm going to say their money manager because I'm hesitant to use the word advisor, that they should take it as soon as possible, invest it. Well, if you don't, you have this guaranteed 6% growth on what your payout for the rest of your life will be until you hit full retirement age, which for most people, not everybody, but most people now is 67, and 8% beyond that. That is something to seriously look at and consider before making a decision as to when to start.
Well, then I also take into consideration too, where again, I don't think that your retirement date should be completely strategized upon when you can take Social Security.
Absolutely.
Because there's a lot of assumptions. Just had a meeting this week with some great people, business owners. They've done a good job to get to the point where the business is operating without their involvement.
Perfect.
So, we're talking about everything from, okay, what's the exit of the business look like and all of that. And yeah, the question they brought up, it's like, well, we can't do this until 67. Like, they kind of had this set in their mind. It's like, well, okay, let's really start to parse this through and see what that looks like, right? Yeah, you're in your early 50s, but if we're anticipating A, B, C, D, E, F, G, then no, this can still work, and we don't not all your eggs are riding on this Social Security. Now, I think to a lot of people's surprise, when you look at the equivalent of Social Security that would pay you, that we could estimate for your lifetime, and what that would equate to like a lump sum pension, it's like, hey, this is actually a pretty big benefit. Like, we don't want to sleep on it. But I think it's just important to know that given the flexibility that you can use with Social Security and the strategies that you can use with Social Security, especially when you have two spouses, one maybe was a higher income earner paying more into Social Security versus one that wasn't, or maybe you're both paid a high degree into Social Security, so you're each getting a higher benefit. That gives you some opportunities to say, okay, maybe my retirement picture isn't all based on a 67. Like, maybe there is an option to delay, or maybe there's an option to where you're drawing down assets, from late 50s to early 60s. And then you turn on the Social Security spigot, because then you can in fact delay it.
Well, and I had a situation that's not as common. A gal come in and meet with me that I've been working with, who got an opportunity for an early retirement package from her employer. And we were looking to see, is this feasible? Is this something we can do? And she's widowed. And so we actually explored the survivor benefit and delaying her personal benefit until later so it continues to grow, and how we could supplement the survivor benefit for a little bit and then turn the other on with this guaranteed income that's at a higher rate.
So the fact that her deceased husband had paid in the Social Security, she can elect her Social Security benefit based on the widow's benefit, which is tied to his,
right,
what he paid into. So she could turn that on at, I'm assuming, age 60?
As early as age 60. That's not where we're a little past that, but that's still, you can turn the survivor benefit on at age 60, as long as you're not remarried.
Okay, so she turned on the Social Security benefit, taking the widow's benefit election because she's has a deceased spouse. So that's cash flow that will continue to come in that otherwise maybe we wouldn't look at doing, because then she's looking at her own benefit. So then we can delay her benefit out, let that continue to grow. I mean, if she goes past 67, she's getting that increase
8%.
of 8% per year. And then you can factor how that works in with the other benefits that she had versus saving with her cash, her investments, and all that.
So even though her personal benefit right now is higher than the widow's benefit, because it can continue to grow, it makes sense to wait on that one.
That is a good real life scenario of how you can strategize Social Security to your benefit. And that's one thing with Social Security I find interesting too, is that there's these specific terms where you have widow's benefit, which is important to note that is when you have a spouse and they passed.
Correct.
Now we're looking at did they have a higher benefit that now you can elect?
Yeah.
And I think in most scenarios it's, you're both receiving Social Security. You're probably well into your 70s and 80s. One spouse had a higher one, and if that higher earning spouse, at least in the form of Social Security, or the spouse that passed away was receiving a higher dollar amount of Social Security when they pass, that amount then carries to the spouse.
Correct. So you will only get one benefit when someone passes away, but you'll get the higher of the two. But you will lose the smaller benefit.
And not to be confused with the spousal benefit.
Oh,
so it's key terms. We have widow's benefit. Widow, I mean, obviously we got to look at the term widow means there was a passing, right?
Correct.
Someone passed away in that household. Now you have the spousal benefit, which means you're alive or separated, like divorce.
Yeah. And that just is Social Security saying that the lower earning spouse's benefit won't be less than half of the higher earning spouse's full retirement benefit amount, but then they're reduced for starting early.
So that is key, in my opinion, when it comes to the spousal benefit, meaning like in my case, Tatum, she's at home with the kids, right?
Yeah.
And I'm the one that's going to be paying majority into Social Security. So assuming it's still there, we got a ways to go. No, I'm just kidding. I put that out there because as a tongue-in-cheek comment. But again, in our situation, let's imagine we were close to retirement. She clearly has not paid into Social Security more than what I would paid. So we would be assuming that she's going to get 50% of my Social Security.
But it depends the age when she files.
Aha. So there's a caveat to this, meaning there's rules and some things that you need to take in consideration when you're strategizing Social Security. We're going to talk about that when we come back.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Did you have a tax strategy going into this year to help maximize your tax savings? I'm Jeremiah Bates with Tree City Advisors of Apollon. We consider key factors like required minimum distributions, Social Security, net unrealized appreciation, 1031 exchanges, and more. Because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then used tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
If you have a small business, Staples has your sign.
Banners for my bakery?
Staples has your sign.
Oh, posters for my new pet store.
Floor decals for a pharmacy.
Every day, Staples associates help every kind of small business create bold signs to make big impressions. And now get $10 off custom signs, banners, and posters when you spend $50 or more. This is your sign, so print it big at Staples. Ends 5/28. Visit staplesconnect.com/thisisyoursign for details.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
Rules, techniques, things that you need to pay attention to that could trip you up. We were talking about Social Security and the potential strategies and flexibility that is provided to those that are approaching Social Security filing ages, which you can do it as early as 62. You can delay as late as age 70. Mm-hmm. Don't advocate for delaying past age 70 because you don't get any bigger. You know, it doesn't get any bigger after 70. So
they even made Bruce Springsteen take his. He got a letter because he hadn't taken it and started.
You're taking it, is that they like to say. But again, when we're looking at the nuances of these types of strategies and the high stakes that you could argue are with Social Security, meaning once you make that election, it's pretty much set in stone. I mean, there are some cases where you do have enough time to maybe change the election, which Alex, you and I have done before with a couple clients.
Unwind it a little bit.
Which I'm glad that they met with us when they did, because they're like, well, I did this. And we're like, well, we got to unwind this hopefully as fast as we can, because actually if we looked at this strategy, like your net benefit's going to be so much better based on your spouse filing and all that. It's like, oh. So it's like, yeah, we got to get on it. But what we were specifically talking about before we had to get to the break, last one is the spousal benefit, why these terms are so important when it comes to Social Security. And again, if you have questions on Social Security, call us. We're live. Phone number is 979-59-MONEY, 979-596-6639. Send us an email, jeremiah@therealmoneypros.com, alex@therealmoneypros.com. So if you have questions, send it our way, because it's great for the community, great for the cause, for getting information out there to the listeners. But going back to these terms being so important, we're talking about, and I can't tell you how many times this term gets tripped up between widow's benefit and survivor's benefit. Or sorry,
spousal.
well, those are the same. Survivors and widows, essentially the same thing. And then you have spousal benefit.
Right.
And the baseline assumption with the spousal benefit is that I get half of my spouse, meaning I was at home.
Whatever they're getting, I get half of that.
Well, again,
amount.
let's go back to my example. My wife, Tatum, she's at home with the kids, and I'm spending my time working, right? So that's just how we're setting our trajectory, which is great. It works. So if we were approaching, let's imagine we're 60 years old, right? And we're approaching, these important dates, these milestone dates of how we're going to approach Social Security, then we're going to be under that assumption that I'm going to have my Social Security benefit. And even though Tatum did work and paid a little bit in the Social Security, I would have paid more. So we're just going to default assume that, hey, when we file, she's going to get 50% of my benefit.
Right.
But is that assumption correct?
Not really. It's nuanced beyond that.
I love nuances.
So everybody has their own earnings record with Social Security. If you've never worked, then yours is a 0. If you've worked at all, then it's got something. And there's a secondary column that gets added to it to create what is called the spousal benefit and to bring that amount up. Both of those columns are also subject to reduction if you file prior to full retirement age. So if you have the lower earning spouse start at 62 and the higher earner then waits and starts later, well, the lower earning spouse's personal benefits been reduced, so you already aren't going to get exactly half. And then if it's still prior to age 67, that gets reduced as well. However, a spousal benefit never gets larger than what they get at full retirement age. So if they haven't filed by full retirement age and the spouse, the higher earner, hasn't yet, they still should go ahead and file at 67.
So let's use this example, right? Let's just use easy numbers, just shooting from the hip, right? Let's imagine that if I filed at my full retirement age, let's just say 67, and my benefit is $4,000 a month, okay? And then my wife, Tatum, she files at her full retirement age, and let's just say her Social Security based on her benefit is, I don't know, $500 a month.
Right.
Right. So she would get $2,000 a month.
Right.
If she filed at full retirement age and I filed at full retirement age, based on those two numbers.
And her benefit would be comprised of $500, which is hers, and $1,500, which is the spousal portion.
So even though the amount of money that's deposited in her account from Social Security totals $2,000 on the back end, what adds up to that total $2,000 is the $500 of her benefit and the $1,500 of the spousal benefit.
And that's that nuance.
And that's the nuance, because now let's enter in a new scenario where let's imagine Tatum filed at 62. She filed early and I file at full retirement age. Then clearly she's reducing that $500 that was based on her full retirement age. I don't know, would be
70% of that,
70.
so I don't know, $370.
Three,
That's a made-up number. By the
let's
way.
call it $300, right? So then she's getting $300, and then when I file for retirement age, then she can get the spousal.
And if she's full retirement age at that point, she'll get the full $1,500 added to her $300. But now you see it's not $2,000.
Exactly, because she filed early, which reduced her number. So then even if you add in the spousal benefit, it's not going to arrive at that total 50% at $2,000. It's probably going to be what, $1,700 or something, something along those lines.
And sometimes that's totally something you should do. I mean, and something that makes a lot of sense to do is to have the one spouse file early and then get the spousal add-on later. But you need to look at the numbers and make sure that that's what you understand is going to happen, because we have a lot of people come through the office who thinks that when the higher earning spouse files at full retirement age, the lower earning spouse's benefit will jump to that full half after they'd filed early, and it won't.
Well, that's something important to take into the protocol, too, if you're looking at the strategy of delaying Social Security, like maybe past 67 to 68, 69, maybe even 70, where maybe the option that you're taking or the route that you're taking is, okay, we want to maximize this Social Security benefit as high as we can because maybe there's some health issues where if that higher income or that the person that paid more into it, let's lock in that higher benefit because then that helps the survivor/widow's benefit. So you can see how Social Security filing cannot be looked alone at like on an island or in a vacuum, right? It has to be incorporated into the entire ecosystem of everything that you have in front of you, because there's also tax tax planning that goes along with it too. Like, meaning, are you better off to delay Social Security because you have other assets that could supplement your cash flow and income, and then that allows you to do maybe some Roth conversions or some larger distributions out of IRAs, and then you can effectively lower that tax obligation, and then you click on Social Security because that could be a big source of income that could potentially throttle you through different marginal tax brackets or IRMA charges, aka your Medicare Part B. So you can see the importance of it shouldn't just be looked at as which one's going to give me more money, like for the here and now, because that could have a net effect across the board, which after you factor in the IRMA charges and taxes, the net benefit to you is actually lower.
Yes, absolutely. It can make a mess. Unintentionally. Again, phone lines are open 979-59-MONEY. That is 979-596-6639. Question about Social Security, too, when it comes to the taxation of it, which, again, I think could surprise a lot of people if they had some type of, maybe they recognized a capital gain, they sold a stock, or they sold a property at some point in the year, or they did a larger distribution out of an IRA. Understanding that how your Social Security is taxed, meaning you filed for it. You're now receiving Social Security. It is now a source of income that is feeding into your household. Not all of it's going to be taxable. No.
Right? The maximum amount of Social Security tax, or the amount of your Social Security that can be taxed as ordinary income, is 85%.
Correct.
So again, when we're talking about strategizing Social Security and understanding the movements that you make throughout the year, you should have that tax lens on it to an extent to make sure that you just don't go from maybe a low amount of your Social Security being taxed to a very high amount of your Social Security being taxed.
And you can also have tax withholding from your Social Security benefit payments. A lot of people don't. But if you are someone who has a pretty high income in retirement, pretty high cash flow, it's probably a good option to explore to have withholding from your Social Security payment.
Yeah, and I don't disagree, because then it comes to this kind of logistics of taxes. And I just had this conversation with a client earlier this week where they finally retired. If you're listening to this, I don't want to give out names, but they were held on by their employer for about almost 2 years because they were doing some contract work, but they finally cut the corporate cord, which is great.
Celebration.
But now where this shifts a bit is now that we're going to start supplementing income from their retirement accounts. And it's important to note that whether it's, again, they have some non-qualified accounts too. So they got some Roth IRA money, they got some pre-tax money, and then they have some non-IRA money that's just been invested. And then they have some other sources of income that are paying through. But one thing that we have to make clear is that, okay, we got to make sure that we tie down the tax obligation that you're going to have, because as you're receiving your W-2 pay,
they're doing withholding. You don't think about it.
You're generally doing withholding, meaning you're paying the IRS as you go. And just because you're no longer receiving W-2 pay and you're still receiving this payment from your other sources, maybe Social Security or whatever, rental properties or whatever, you still may need to pay along the way. Now, the reason why I put that asterisk there, may, is because you could run into penalties if you're not paying your quarterlies as you go throughout the year.
Yep.
Now, there's some scenarios where actually that penalty and the interest that you would be charged for not making that quarterly is so negligible that I know some individuals like, I don't care. Like they're going to penalize
more money,
but I'm making
invested,
making more money with it invested. So when we net it all out, that penalty, like actually I netted a better benefit because I wasn't paying along the way. And now I have some people that I work with that are like, no, I'm not paying a cent more. So if that's the case, then we have to take that estimated tax into the protocol.
Yeah.
And that kind of leads you back to your point, Alex, where if you're doing tax withholding from your Social Security, you're paying as you go. Some important tax nuance there. We got to take a break. This is The Real Money Pros. Stay with us.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs, from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Back to the Real Money Pros.
TheRealMoneyPros.com is where you can find us. Interactive site. Take our Better Buckets assessment. See how the bucket strategy can help you. A lot of market volatility. Obviously, we talked about the U.S.-Iran conflict, and listen, that there's risks that are abundant when it comes to investing. But again, that tail should not wag the investment dog. It should be the other way around. Your investments, your allocation, I know it's a jargony term, but meaning these things should all be coordinated and planned for to serve you and be able to not invoke bad emotions or fear when you see these types of things happen. So that's where the Better Bucket strategy can help you. So go to therealmoneypros.com. And again, phone lines are open. We're live, 979-59-MONEY. That is 979-596-6639. We're going to go to the phones right now. We have Jim calling out of San Diego. Jim, thanks for holding. What can we do for you?
Okay, so I heard you talking about Social Security, and I had a couple of questions. So about 4 years ago, our family sold a business, and I paid off $60,000 in federal income taxes.
Ouch.
But now the last 2 years, I've got my Social Security statements, and it doesn't reflect that I paid those taxes.
Okay. You need to reach out to them and get that fixed.
Well, here's the thing. I've tried to reach out the accountant. She had another baby and she retired.
Okay.
And so do I go back to the original CPA that owns the accounting business, or can I do this through the federal government?
You should, if you have copies of, what you paid and what it was for, you should be able to do this directly through the Social Security Administration. Now, I will tell you, getting to where you actually talk to a person is no longer easy unless you're lucky and your local office is still open. They've closed a lot of them, but you do it directly through the Social Security Administration. So, and if you don't have the documentation that's needed, I would go to the owner of the accounting firm to see if they can get that for you.
Okay, that's great. Now, I had one other question. The accountant was supposed to they had a federal tax lien, and she supposedly paid off the taxes, but she failed to. I don't even know the how to do it, but I still once in a while get a call from somebody from IRS. We can help you. You have federal tax liens.
Ooh.
How do I find out about whether I even have those tax liens? Because I don't get anything from the government anymore.
Yeah.
I got stuff all the time. We paid off the taxes, and I've never heard from them again. But now I get calls every once in a while that says, "Hey, you have a federal tax lien." How do I find out
if you really
run my credit?
Well, I think the first step, in my opinion, would go set up. You may already have this an account with the IRS, and you can meaning. Not necessarily an account, but it's a login where it allows you to get previous transcripts. I would imagine that within that same login, that portal where you can get your previous transcripts, you should be able to find like previous tax notices or see if there is in fact a lien. Because I do know I've worked with a client previously where they had a payment plan with the IRS, and then they were able to log in through that lens. They could get previous tax returns. They could see the transactions and the balance that they were paying down on that payment plan. It was all through this clean portal. I would say start there, and then hopefully there's some type of confirmation or some type of documentation that shows that and that it's been settled. Then if not, I mean, probably not the path of least resistance. You'd run into some friction, but reaching out to the IRS and through some channel just to get that confirmation. But if you have a high degree of confidence that that was in fact settled, it was probably some separate business that got like marketing company that's trying to help you and get your money to say, hey, we can represent you with this. That would be my guess.
Yeah, we're in the real estate business. I get random calls all the time. So that's a great idea because I have a portal with a franchise tax board in California. I never even thought of that. That's great. I'm glad I called you.
Well, good.
All right, Jim. Hey, certainly appreciate the call. Thank you so much. Jim, it's that stuff happens. I mean, I think it's important to note too. I mean, it sounds like that the accountant did it accurately. So now it's just making sure everything's lined up and what's with being reported to the IRS. I will say this: I have some clients that have. They filed their tax return, they mailed the check was negotiated, and they're still getting notices from like 2 years ago of like, hey, you didn't pay it. And it's like, my return was filed, you negotiated the check, like I see it, what's going on? And again, you obviously want to make sure that everything's above board and accurate, but the takeaway that, at least for these clients that have ran into it, their CPAs have been like, yeah, the IRS is just so far behind, like they're sending out notices that are not even applicable from like 2 years ago, but just a little note there. But if you are getting notices like that, just make sure that everything is squared away. You don't want some loose end, especially with the IRS saying that you didn't pay or that you owe a certain balance that has in fact been satisfied. Okay, again, lines are open, 979-59-MONEY, 979-596-6639. We're going to go back to the phones. We had Daniel calling out of Silver Springs. Daniel, what can we do for you?
Hi, thank you for taking my call. I'm 80 years old, and I've been taking Social Security since I was 70. My wife, however, just turned 59 in January, so she won't start. Should she start taking it at 62? I just want to know what are the tax applications to her taking it. Oh, if I'm getting Social Security, does she get a whole check when she starts taking it at 62, or what? How does that work?
So 62 is a reduced amount regardless of whether it's her benefit or spousal.
Sorry, Alex. Daniel, has your wife received a statement from Social
like
Security, like an estimate of what she would receive if she filed it for retirement age 67 or if she filed at 62?
I don't know for sure, but I don't know for real.
Yeah, and if she hasn't gotten one, she can set up an account on ssa.gov for Social Security Administration, and it will show her the estimated amounts for basically every year between 62 and 70, which is kind of handy to see, because you may decide, well, it's reduced, but it's plenty, it's all we need. Taxation on Social Security depends on your total income it's calculated a little differently than your taxes. It's your outside income plus half your Social Security, and whatever that dollar amount is, it will indicate if any of your Social Security is taxed, if 40% or 85%.
Yeah, Daniel, I mean, if I was going to summarize that, like, should she file at 62, that answer is going to be met with it depends. And how you solve for that is get that statement from Social Security so you know basically exactly what they anticipate your wife will receive based on when she files. And if, obviously, let's just say if she was going to get $1,000 at age 67, and then if she was going to file at 62, and maybe that amounts like closer to 600 or 700, you're like, well, we're certainly going to get a better benefit if we wait. Then you can kind of logic yourself into it that way. And then when you ask that question about the taxation of it, you're absolutely right. Like, any money that your wife would then receive from Social Security is it's going to just be added into your total household income. And depending, like Alex said, how her Social Security is taxed, and yours for that matter, Daniel, comes down to what's your total household income, right? And what amount of that is derived from Social Security. And then they basically say, okay, this percentage of your Social Security is actually going to be taxable as income. Yeah. So I mean,
hold up. President Trump just said no tax on Social Security.
Okay, that is a big a big misconception. Okay, because I've been hearing that from a lot of clients. That did not happen, but what did happen is that they're doing an enhanced standard deduction. So what that means is if you are over the age 65, and let's just say that, Daniel, in your case, you're married, you can get an additional $6,000 of a standard deduction. So again, if your modified adjusted gross income for a married couple filing jointly, so Daniel, we could say that in 2025, then you'll likely get an additional $6,000 of a standard deduction. Now, your wife's under 65, so she won't get $6,000, but you will. So yes, not all of Social Security, that did not pass, meaning Social Security taxes were removed, but there is this carve-out. It just got
a little twisted when it went through Congress and the IRS. They did it a little different.
Yep. Daniel, we're up.
I was thinking I was thinking about Social Security is tax free. I was happy. I was jumping.
Dan, you're not the only one who's thought that, so I'm happy we could provide that clarification.
Although it's bad news, sorry.
I wish it was all good news we could give. Certainly appreciate the call. Again, this all comes down to knowing the details and how to file and strategize. This is the Real Money Pros. We will take a week break. We'll be back next weekend. Thank you.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational material, and more. This program is